I recently had a conversation with a good friend of mine, and he was bragging how he makes more than 200K a year in one of those big tech companies. But the thing is, Uncle Sam keeps about 30% of that money. And what my friend doesn't know is that there are many real estate investors out there making 10 times that money and paying zero taxes. How do they do it? Because they use the biggest tax haven in the US. It is called real estate depreciation. In this video, I'm gonna teach you how they do it so you can keep all of your hard-earned money. Stay tuned to find out. Okay, so now let's talk about what we need to know about real estate depreciation. Okay, the first thing we have to know about real estate depreciation is the timeline. Here in the US, the IRS let us depreciate only the building for residential buildings through 27.5 years. And if we are talking about commercial buildings like retail, industrial, office, or other building that it's not residential, we have to depreciate it over 39 years. Okay, so residential, it's not only single family, it's also multifamily. Okay, and the second thing we need to know, it's depreciation, it's only for the value of the building, not for the land. If we purchase a property for, let's say, 1 million, we have to calculate how much is the value of the building and how much is the value of the land. We can go to the appraisal district maybe to find the value of the land, or we can find it other way, but we have to separate both because we are only depreciating the building. The third thing, it's not an expense. It's not an expense. This is important because the difference between expense and an investment, it's expense you can write off in the year you made expense. If you made a maintenance expense, maybe you pay your HVAC technician $100 or $1,000 to fix the heater, you can write off that expense in that year. But if you purchase a building, that's an investment, so you have to follow the rules for depreciation if you want to write off that investment. Okay, so the fourth thing is improvements are also depreciated. These are not an expense. This is a common mistake because many people make improvements in a rental home and they try to write off as an expense. That is not the case. You have to sum up the cost of all those improvements and then depreciate as it's a new building. Okay? The fifth thing, we have to separate active or passive losses, because you in the next whiteboard you are gonna see we have losses because of the depreciation, but those losses are only in the paper. In our bank we still have the cash, but we have losses in the paper, but those losses are passive losses. So the IRS, they don't let you write off or mix the active with the passive losses. For example, if you made like my friend 200K a year working for a company, that means you cannot write off your losses on your real estate business with your losses on your W-2. So unless you are a real estate professional, and that doesn't mean you have a license, that means you have a real estate business, maybe a construction business, maybe a rental business, and the IRS has some rules for this to classify as a real estate professional. Okay, but this is a topic for a new video. And then the following thing we have to know is cost segregation. Okay, this is an important one because we may purchase a property, let's say for 1 million, and let's say the building is 80% of that value, so $800,000. Okay, so if we go with the simple rules of depreciation, we may say, let's say this is a industrial building. We have to depreciate those $800,000 through 39 years. Okay, but with cost segregation, we can split those $800,000, and then we split in several expenses like the carpets, the blinds that depreciates through 5 years, and then the driveway or the fence that depreciates through 15 years, or maybe some lights. We have special lights that depreciate through 7 years. Okay, so that makes you to have a bigger loss in the paper, because we are accelerating the depreciation. Instead of 39 years, we are depreciating in 5 years some elements, some others in 7 years, and some others in 15 years. Okay, that is called cost segregation. And if you want to make this, you have to pay and study with an engineer or an accountant that specializes in this. So this have an extra cost. And the last thing we have to know is bonus depreciation and the big beautiful Bill Act, okay, that was passed as a law last year in 2025. So bonus depreciation is basically you have these elements you already separated, and if you have some elements that depreciate in less than 20 years, then because of this law, you can now depreciate it in 1 year. In the first year, you put in service that property. So if you purchase in 2027 an industrial building for 1 million, then you can depreciate those elements in 2026 because you put in service, you rent that property in the same year. Okay, so that makes you even more losses in the paper. Okay, so in the next whiteboard, I'm gonna show you an example of this. So let's figure out how depreciation works with an easy example. So here we have an active income of $200,000. It comes from an employee, from a W-2. We also have a portfolio value of 5 million on properties, and we have a net operating income for all our portfolio of $70,000 a year. Why that low? What is that low? Because we have a high leverage on those properties. That's a secret about depreciation. If you increase the leverage in your properties, you maybe don't have too much cash flow, but you keep all that depreciation, and that depreciation, it's a gift from the bank because you are asking for the money from other people money, you know, and they are gifting you that depreciation. So that's why we don't have too much income here. So because we have to pay interest. Okay, so what's the annual depreciation for our income what's the annual depreciation from our portfolio of properties? It's 39 years. We have, let's say, 5 million on industrial properties. Okay, so because industrial is commercial, we depreciate over 39 years. So we divide the 5 million value of, this is only the value of the buildings. Okay, so we divide the value of the buildings 39 years, and we get $128,000 depreciation losses for all our portfolio. Okay, so what is our passive income or loss? So since we have 70K net operating income coming from our portfolio of properties, and then we have $128,000 depreciation from the same portfolio, then we have a loss here. But remember, this is a loss on paper. We still have the 70K pocket money in, but in the paper we have a loss of almost 60K. So let's figure out what can we do with that loss. Okay, we are not paying any taxes on the passive income because we already have a loss, but let's figure out if we can carry that loss to the active income. What's the active income loss? It's we have the 200k from coming from our employment, and then I told you in the whiteboard before that unless you are a real estate business, you can write off those losses, but that's not totally true, because the IRS can allow you, if you are not a real estate professional, then they allow you to write off up to $25,000 from your active income. So that's what we are doing here. So we subtract 25,000 from the active income and we get $175,000. So less taxes to pay. Okay, so how much taxes are we paying? So we multiplied 170k by 30%, more or less it's the rate for this income, and that will be around $52,500 for the taxes we have to pay. How much money we get into our pocket? We have the 200k, that is the active income, plus the passive income, less the total taxes we have to pay. So money in will be $217,500. It doesn't end. What we do with the additional loss we have, because we only take 25,000, remember, but we have more loss. Okay, even if we cannot use that loss this year, we can carry for the next year. So we have the loss of $58,500, and then we sum it up with the 25,000 we already take for the active income, and then we have a total loss. This is a loss of $33,500. So that loss we can use it in the next year. So we can do the same thing. We can carry this to the active income for the next year. And remember, if you are a real estate professional, you can write off all those losses. But as I told you, this is a topic for our next video. In this video, I show you how successful real estate investors do to pay zero taxes, even if they make tons of money at the end of the year. But I'm curious, what other strategies would you use to pay less taxes? Leave your answer on the comments. I would like to read your answers. Thank you for reaching this point and watching the full video. If you like this video, please give me a thumbs up. It helps me a lot. And remember, if you want to get notified every time I upload a new video, subscribe to my channel. That way you will not miss any video. If you want to invest in real estate, but maybe you don't have the time or maybe the money to start in commercial real estate, you can join my exclusive investor club. My investors start investing from $20,000 US. And the best of all, it's totally stress-free. I manage everything. You can join by clicking on the link below. Thank you for watching this video. I hope to see you on the next one. But in the meanwhile, I will leave you with 2 more videos.